Now, on to today's market movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Urio, and we're just days away from the August employment data. We're looking at using E-mini options, ES, to either hedge risk or create additional exposure to this volatility-inducing event. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, so we've seen a little stock weakness over, let's say, the last 24 hours. And stock weakness, even if it's only 24 hours, has been unusual over the last few weeks. Is this a market position thing, or has there been a fundamental change in economic data and Fed policy? What?
Let's call it market mood change, and maybe the market getting off its medication, because you're right. And in the last few weeks, and even a couple months, Jim, the market's been pretty calm. So when these days tick in, as far as, when you start seeing volatility start to tick up, you start to see some of the leading names in this rally start to sell off big, as we've seen, Wednesday morning and Wednesday afternoon. That, to me, is an indication that, yes, the market is maybe changing its mood a little bit. Maybe just for a couple days, though.
Is it coincidence that it's happening 2 days before the unemployment number, or does that have something to do with it?
It may, and I think it's also not maybe a coincidence it's happening when we're having some of the tech executives in front of Congress, and also the impending China tariffs, too.
I think the tech thing is more important. Now, before we dive into our trade discussions, I'd like to point out, with all market movers, it's important to view these as examples that allow you to see different ways to use futures and options products, either to manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements will vary in the market. Scott.
Yes. Well, Jim, you always scare me. You take it easier on me, man, especially when we have volatility going on. I'm a little bit unsettled. But as we talk about these trade expressions, as we go into positioning something for the future here, I always like to do a couple things. First is look at the charts and see what the charts tell us as far as whatever market we're looking at, and see maybe where there's some support, resistance. And then look at the pricing of the options, too, because I believe you can also get an indication as to where maybe the market wants to go vis-a-vis what folks are paying for calls or puts. So, of course, as usual, I think I found something interesting in that analysis. Specifically looking, Jim, today at buying the week 2 September 2,900, 29.25 call spread on the ES for 8 ticks. However, that's not my only move today, my friend. I'm going to move another chess piece. Yes,
okay.
Wait, there's more. Wait for it. I'm going to finance that partially by selling a put on the ES at 28.50 for about 7.5 ticks. Again, same expiry. And this is what's called basically a bull spread risk reversal. Expires on September 12th. The trade risks about $25 to make a potential $12.25 if we go up from here and that call spread fills out, with some risk, obviously, on the downside if we fall below that 28.50 level, and therefore I get long at that level, and I'm holding the ES.
So the 28.50. So let's underscore this. You're selling a put, a naked put, which everybody thinks is the most risky thing to do. But you're saying is, if you are willing to buy at 28.50, that's the level,
right? See some key levels in the market, yes.
And that's where you're willing to buy. So you're selling that put, and if you buy it, you're fine with buying it there, and you accept all the risks that comes with having a long position. That's what you're talking about,
Very
right?
true. And because I feel that the call spreads out there are somewhat relatively cheap. Puts are obviously bid up in the last couple of days. You mentioned volatility's kicked back in. So to me, that was a nice expression of still being bullish by being able to finance it a little bit.
And I like this, and I do strategies like this too, but many times we talk about strategies where you can sleep well at night. This isn't exactly one of those. You have 40 ticks of room between now and the expiration. So, okay, if you're willing to accept the risk, I get it, and I do stuff like this on occasion.
Awesome.
Okay, I'm looking at it a little bit differently. I'm looking at buying the Wednesday, week 2, the same one you're talking about, the 28.75, 28.50 put spread. This is me saying a put spread. I know I'm normally been bullish for the last, call it 8 years, for 5 ticks. It expires September 12th on the Wednesday, and as SEP underlying, it risks $250 to make a potential $1,000. Now, there's 2 reasons I like this. One, the market traded poorly the last couple of days. Higher high yesterday, lower low, finishing kind of badly. So to me, it looks like it's poised for a little bit of a pullback. You mentioned the tech hearings, but also I like this too, because I, along with a lot of other people, are net long stocks. So if you throw in this as protection, if I lose my $225, okay, so be it. I'm protected until next Wednesday.
It's a nice hedge, given that it's that short period of time too where we could see this volatility just rush in and wash out a lot of weak hands. Plus, my friend, you are still crazy after all these years, because that 28.50 on the bottom of your put spread happens to be where I sold mine. And I like that level too.
Okay, in one word answer, do we want good data or bad data for the stock market on Friday?
No. Good data, I believe, because this market still is hinging upon the economy improving, and the Fed is going to keep hiking rates.
Me too. Thanks for joining us on Market Movers. I'm Jim Urio, where we're helping to make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.